Big time investors are selling stocks. There have been swings up and down over the past year, but in general, investors have been net sellers of equities for 1 year. This is a very bad sign for what's to come. Certainly, we don't know what will happen with central banks, but the way it looks, they are pushing very hard for significantly easier monetary policies, which will be sure to exacerbate the current massive debt load the world is already under. Look out below. You came here for the truth, so let me unveil that for you. Today we're going to talk about money fleeing. Now you might think to yourself, look at the S&P 500 and where it is today. How could it be possible that we are seeing money leaving? This is an issue I have been covering now for 1 year. We've been watching all of these equity outflows taking place. It's not just in one market, even in the United States. This is actually happening. Where is the money going? Well, let's get into it. I'm going to show you 3 separate sources right now so you can confirm this 3 times. Investors flee emerging market funds during the third quarter. This one here covers specifically with the emerging markets. I will show you 2 others in just a second. This data comes from Lipper, which you may know. There's the EPFR, there's the ICI. There are others out there that give you this data on a regular basis. I'm bringing you 3 for today's video. Lipper's emerging markets peer group, including both mutual funds and ETFs, experienced net outflows of $1.1 billion for the fund flows trading week ended Wednesday. That was the 10th net outflow in the last 11 weeks for the peer group, during which over $11.8 billion has left the group's coffers. It's going to go into a lot more detail, a lot more specific numbers and things. I don't want to bore you, but this is the general consensus that money has been leaving out of these emerging market funds, which includes mutual funds and ETFs. They're talking about how this is in relation to the trade issues that are being experienced between the United States and China. Just like everything else around the world, there is concern because of the trade issues. If you look at what's going on in the UK, everything is to do with Brexit. Okay, there's always an excuse that they're willing to use, but of course, never the underlying economic structure. That is never the case. Don't worry about it. Even when the recession is fully on, nobody's ever going to admit it. They're just going to say, well, if nobody would have sold, everything would have been okay. Well, that's not exactly how it works. It is all about central bank liquidity, and that's why I mentioned that in the introduction. Emerging markets funds, including both mutual funds and ETFs weekly net flows from June to August, you can see this for yourself. It has not looked good. We are seeing a lot of negative, a lot of contraction, and this happens to relate to what we're seeing out there in so many different cases, not just the fund flows, but in general, there is a contraction going on in the economy. Now we're looking at the ICI, combined estimated long-term fund flows and ETF net issuance. All right, now this is coming at the end of August, and you can see over the past little while where the money has been flowing out of. Clearly, right now, equities are losing a lot of money. There's a chart at the bottom, but the summary is essentially that total estimated outflows from long-term mutual funds and exchange-traded funds were $10 billion for the week ending August 21st. As you can see on here, bonds have been receiving a lot of the funds. As you can see on here, bonds have been the recipient of a lot of this money. We have also seen money flowing into gold. When you watch that gold has been slowly but surely going higher and higher, this is only going to happen when people are scared, people are worried. Look how gold was performing for years. It was trading within a range because there was all of this certainty that everything would be okay. Now, even though we have witnessed central banks around the world doing everything they can to maintain order, we have something going on that doesn't seem to be stopped, doesn't seem to be resolved by what the central banks are doing. This is a very tricky time frame right now in the second half of 2019. Here is the next one. Global equity outflows amount to 3% of assets under management since December of 2018 versus 7% during the last recession. And here's a chart that compares that. Of course, we're looking at the data coming from the EPFR. They track all of this. I have shown you it many times before, but here you can see the current outflows and it happens to look very familiar. We also had something similar happening in 2015 into 2016. You know that the whole world was basically at the edge of recession and the central banks were basically suggesting that they would go all the way, even though we had the Federal Reserve that basically flatlined the amount that they were printing. We had other central banks around the world that started to print extra trillions to try and kickstart the economy. Regardless, we have seen this pattern before and it isn't good. Now you must understand that when this happens, it looks like the recession is already on. That doesn't necessarily give you an idea of what's happening this time, but if last time and this time are similar, here we can see that perhaps it has already begun. That recession is already underway. You see, the market prices things in advance. If it thinks there's going to be a trade deal, the market goes up even before a trade deal is signed. That's just the way it works. But when you look at the actual economy and you see the contraction taking place, those numbers are coming out all the time. You don't need to worry for an official statement saying we are now in a recession. They're going to tell you way after because they don't want people to freak out. That makes things worse, of course. If they could simply never admit it, they really never will. Okay, so that's three separate sources. Okay, we're looking at emerging markets, we're looking at US markets, global markets. Everything seems to be affected right now, and there's no other way to put it. I mean, I'm showing you all of the data, and it is an absolute fact. Yet we see the stock market that is actually quite high. So what exactly is happening? I have covered this many times before, but for those who are new to the channel or are unaware, stock buybacks are the absolute number one reason why we have seen equities that have risen to these levels. Now you might think, okay, well, they'll just continue to buy back more stock and there's nothing wrong with that. Well, there's an issue because if you look at what happened in the previous time frame, just like we see here today, and no different than what happened back then, there is a concern about earnings, about the potential future. And of course, we saw stock buybacks dropping down just like this. And that's not a good sign for what's to come, because if we see that the earnings happen to be the same as last time, the same as the time before, they weaken during these periods of economic contraction, of market uncertainties. And of course, here we have the potential problems that could be faced as a result. Stock buybacks go down, then of course equity prices will follow. This is something that is important to note. The gap between equity flows and market levels remains wide despite the recent correction. Now take a look at this. You can see it on this chart here, where essentially you're looking at the equity fund flows, that is the light line, the lighter blue line, and then we have the MSCI World Index, which has completely fell apart from each other. And this is particularly evident as of 2019, basically. And that's not a good sign. Because when you see these messed up indicators, it shows you that something is wrong. And when you see this, something is going to break. Okay, that's just the way it is. Now, when we have these fund flows coming out, that is real money. We're talking about big investors. We're not talking about the 7 share of Amazon type investor. We are talking about all of these different funds. Now, that doesn't mean that all fund companies are selling. No, but we can just see the general trend. More money is going into bonds and more money is leaving equities. At the same time, we have watched the most massive experiment in the history of the world with what central banks are doing, and part of that has been this incredibly stupid creation of the negative yielding bond. I mean, the concept is just ridiculous, that you would be able to actually go below the level of zero and charge people for the privilege to hold on to your debt. So you are a country that may fail in the near future, you may default on your debt, and yet you are going to actually be taking money from people to hold on to a piece of it. It is ridiculous. I talked about what happened in Argentina with the 100-year, the century bond. Imagine today how people had been buying this up, investors, companies had been buying this up like it was candy and actually oversubscribed on that because there was actually some yield there. And of course, as I say it all the time, they're not going to hold it for 100 years, but that doesn't matter. They shouldn't even touch the stuff, all right? You don't want to touch it with a 10-foot pole, but yet they do. This is the problem with the markets today. When we bring interest rates down to these levels, these companies need to take extraordinary measures just to make some profit. I want you to pay particular attention to the chart on the right-hand side. Pension funds have cut their equity allocation since 2007. I actually find this very interesting. It was surprising to me to see it, but here you can see the data for yourself. Now, this is Bank of America showing you this, and of course, it was 61% back in 2007. As of 2018, it was down to 36%. Very different. That is a very significant change. Now, I want to see updated numbers on that, of course, because I'm not so sure that all of this can be explained so easily. Today we have watched so much money flowing into bonds, and this right here just shows you that there has been a big change. Now you can actually see that fixed income has grown considerably over this period of time as well. 32% back in 2007. As of 2018, that's 49%. So I'd like to see some updated numbers, and of course, if I get those, I will bring them to you. What's happening today with all of this money, the way it's flowing is very troublesome, and I'm keeping my eyes peeled. US equities at 70-year highs versus European equities. This is incredible to see that it was trading within this range for decades and decades, and now it has gone through the roof. Since the financial crisis, it has been very clear that the United States has been leading the charge. There is no other way to put it. If you look at different indexes, whether it's specific to a certain sector like the bank index, or simply focusing on some of these European nations, we see that there has been a lot of trouble since the financial crisis, the sovereign debt crisis. We've had issues going on in China, let's say from 2015 and basically onward. We have problems, but in the United States, it seems like, well, you know what? It's the least ugly one of the bunch, so let's put our money there. All of the faith has been left with the Federal Reserve and their complete insanity. I worry about this a lot because, of course, if you had actually done your research, you would know how the Federal Reserve was set up in the first place. They are not your friend, I assure you. They don't even care about the big companies necessarily. You need to know the history of this institution. Operating profits of US companies, and you could see something interesting on this chart. Right now, by the way, it is in a contraction, but every time that this occurs, we are already in a recession. You can see in the previous two times, that's exactly what occurred, and of course, here we are today. Not the first time that this has happened in this cycle, but of course, it is worrisome regardless. This is showing you the percent change over the last 5 years coming from the Bureau of Economic Analysis, and they put this data together and it's very clear to me. This goes in line with so many other indicators that I have shown you and that I will talk about here. Profits for the S&P 500 listed companies are expected to fall nearly 3% this quarter. That represents a significant slowdown from last year's rapid growth in corporate earnings. One of the issues here with this corporate earnings, with everything we have been seeing with these corporations, has been specifically because of the fact that they have, number one, been buying back their own shares, and number two, they are doing so using debt. Okay, so we have this expansion of the debt created and financed by the central bank policies, and as they go lower, this is going to create a bigger and bigger bubble. But people can't connect the puzzle pieces together. They can't simply sit there for 5 minutes and just think about it all in their heads. Doesn't take a genius, doesn't take a crystal ball. But if you do agree with me on this subject and you see what I'm doing here, piecing this all together, please let me know in the comments. It is so important for us to get together and learn all of this as a student. We are students of the data and students of history. This right here shows you JP Morgan's global manufacturing PMI. That's at the top, and the PMI sectors, looking at the different sections here, all listed below that. And you can see nothing but contraction top to bottom. I mean, come on, let's just look at these charts. First of all, they have broken below the 50 line, which is essentially showing you a contraction, as well as all of these. I mean, if you get July's numbers in here, many of these have fallen into contraction territory. Very important to follow this, because it is not just a phenomenon that is in the United States, but of course this is happening all around the world. That's all for this video. If you found it informative, hit that thumbs up button. When you hit the like button, you are supporting me, supporting this channel, so I do appreciate that very much. If you want to learn how to build a business from scratch with very little bit to start off, I have the free e-course that everybody needs to see, and that is the Amazon GPS. It is a step-by-step guide teaching you everything you need to know. I will be adding more content to it this week. Definitely check it out at the AmazonGPS.com. If you want the financial education that was not taught to you in school, I'm talking about how to get your knowledge up to speed, okay? This has been hidden from us the whole time, and we need to understand all of the details. Check them out at the link in the description if you want the audiobook. That's available at themoneygps.com. Hang on, hold on. 8,000 plus stores are closing in the United States. If you haven't seen this video already, I go through everything you need to know. It is the most detailed one on the subject I have done. Click on it and I will see you there.